If our economic predicament is not President Obama's fault, whose then is it? The answer is not just President Bush. The question is not at all academic, because unless Americans see what happened, the same people who broke the system then will succeed in keeping it broken now for their own gain. The key here that financial firms and their executives are not synonymous, that executives got rich by risking their companies, not so much by breaking the rules, but rather by breaking the system of rules, systematically rewriting them over decades, hoping to muddy the waters about culpability now to prevent the return of those rules later. A report from the nonpartisan Wall Street Watch Project reveals that the deregulation was bought and paid for by Wall Street executives, paying politicians, buying unprecedented freedom from Washington oversight, specifically Wall Street, meaning banks, security firms, private equity and hedge funds, insurance and real estate. In just the past 10 years, they spent more than $5 billion to push Washington out of the way. From 1998 through last year, spending $3,441 million on lobbying, employing 2,996 D.C. lobbyists last year, not counting untold lobbyists in the 50 individual states. They put 142 former Washington officials on their lobbying payrolls. They spent $1.7 billion in direct campaign contributions. And here's what they bought. In 1998, Citibank was allowed to merge with the insurance giant Travelers, even though it was literally against the law for that to happen. Citibank won an exemption because everybody knew they were about to get the law changed anyway. A year later, Congress obliged, killing the landmark Depression-era Glass-Steagall Act, which had erected the wall between regulated Main Street banks and unregulated investment banks. Without that wall, the stage was set for firms to merge until they were, quote, too big to fail, and to sink the money from your checking and your savings accounts into risky new derivatives. Regulators let firms hide those risky investments off their books, which meant they did not have to keep enough money on hand to cover possible losses. All of this permitted by the Financial Accounting Standards Board in rules pushed for by the bank executives. When a Clinton regulatory agency said, hey, we want oversight on these derivatives, Clinton's own Treasury Secretary, a Goldman Sachs veteran, said no, In 2000, then Senator Phil Gramm, John McCain's reported choice to be Treasury Secretary had he been elected, got legislation through Congress signed by President Clinton that set derivatives free from virtually any regulation. In 2004, the Bush SEC scrapped a 20-year-old rule that made banks keep a certain amount of cash on hand to cover investment losses. So who decided now how much cash the banks had to keep on hand? The banks did. That new rule, pushed by Goldman Sachs and its chairman, Henry Paulson, future Treasury Secretary for Mr. Bush and star of the bailout crisis. Why would Wall Street executives push for all this change? With derivatives deregulated, financial whizzes could turn bets on just about anything into a derivative. And they did, including mortgages. Once they could turn mortgages into derivatives, they had every incentive to make even the worst mortgages. Yes, predatory lending, because they could turn them into derivatives too, and then sell those things to somebody else. Of course, no financial firm would buy a derivative based on a predatory mortgage, because then they could also be sued by the borrower, correct? Well, no. Wall Street accomplices like Congressman Bob Ney blocked efforts to let the victims of predatory lending sue everybody who profited from it, and leaving Wall Street executives with virtually nothing to risk by pushing the worst mortgages imaginable and millions to gain by using the exploding paper value of mortgage derivatives to win big bonuses of real money for themselves. All of this fueling the housing bubble as mortgage brokers and lenders told the worst borrowers, sign on the dotted line. And the regulators who could have stopped it? According to Wall Street Watch, from 2002 to 2007, the Federal Reserve took a grand total of 3 formal actions against subprime lenders. From 2004 to 2006, the Bush Treasury Secretary or Comptroller of the currency took a grand total of 3 consumer protection enforcement actions. He wrote a new rule to stop states from enforcing their own consumer protection laws, and he used a clause from a law passed in 1863 to nullify state anti-predatory lending laws. That's all over with Republicans out of power, right? Except that Treasury Secretary Tim Geithner's chief of staff is a former Goldman Sachs lobbyist. Another Goldman Sachs veteran, Gary Gensler, is Mr. Obama's choice to head that same regulatory agency that once tried to oversee derivatives, but who, at his hearing last month, refused to apologize for having opposed regulation of derivatives. And except that, as of 2008, Democrats now get more Wall Street money than do Republicans. And according to the newspaper The Hill, big banks getting bailout money gave politicians more than $250,000 just from November 25th to the end of this January.